Having some hedges in place, of course, the volatility conditions thus far have allowed us to put in place some protection, but also at stock picking level, trying to a certain extent not to be tempted to enter at this very phase in values, in cyclicals, so there is still a window for opportunities, but try to be much more balanced, having a look to all those quality sectors that normally, including technology, that normally tends to perform when we have this inflection of the business cycle and the level of the growth lose momentum. We think pretty much this is the situation we are seeing this fall.
Good morning, Francesco. You put in your notes, and you've already alluded to it, concerns about China and technology regulation there, and we're seeing it almost on a daily basis. The question that you have is what kind of capitalism China wants to support moving forward. Do you have any answers for us on what you think the kind of capitalism China wants?
But for sure, the idea is to grasp more popularity, try to do all those reforms that are to some extent able to transfer part of the profits from an elite of capitalists to the majority of people. I think that we have around 40%, according to Xi Jinping, of people in China that are living with less than $140 per month. So that's definitely something that is quite popular. I think that there is a second big problem that is a problem of control in terms of data, controls in terms of geopolitics that this kind of reform wants to spur. We have to remember that we have been counting year to date around 30 regulations. Only perhaps 40% of them have been affecting the technology sectors, but this measure seems to be much more pervasive and going across a variety of sectors. So, like you said correctly, it's a brand new idea of capitalism. The big question is whether this will be digested by investors. At the moment, Western investors have been a little sidetracked, I would say.
What does that mean for your clients? What does it mean for Western investors? It makes it very tortuous in which asset classes, which assets they can look at without worrying about a regulatory backlash at some stage.
At this point, I would say that the preference in the equity camp is definitely for developed markets. We are looking to US, of course, but also Europe that seems to lag a little this inflection of the business cycle we were describing before. At the moment, I think it's advisable to stay a little cautious on emerging market, though many investors are looking to China thinking that a lot is already in the prices. That's not, unfortunately, our idea yet. In terms of fixed income, perhaps the hunt for income will continue. Because of that, I think that looking at China, the fixed income market and the govies market is perhaps a little of a safer place than the equity markets at the time being. So if we have to compose an ideal asset allocation, we prefer to stay more committed with the proper hedges in place on developed markets where the visibility at the moment is higher, and still having in place the exposure to credit and the exposure to some emerging market bonds that, after the testimony of President Powell in Jackson Hole, seems to be still quite supported by a dovish stance from the Federal Reserve.